We're interested maybe in your perspective in if indeed the bubble that burst in technology somehow led to speculation in real estate, or if there's any connection in your mind between perhaps the tech bubble collapse, the real estate boom, and now the current collapse in mortgage.
Oh, I think there is a connection in that you have a lot of people around the world with money to invest. You know, huge pools of wealth that have been created over the last couple of decades, and they're looking for places to get extraordinary returns. They don't want to sit in treasury bills and get 3%. And the way to get extraordinary returns, people discovered, was to lever up. Borrow, use leverage in various ways, do it in the derivatives markets, however you can do it to lever up. And that has created this ridiculous excess in the credit markets that's now being squeezed out. Trillions of dollars of leverage that were created over the course of the last decade that now has to be squeezed out, and it's causing tremendous pain for financial institutions. It's going to cause a lot of failures among hedge funds, private equity. You know, we haven't begun to see the full extent of that. A lot of wealth is going to vanish. And there'll be some real economic effects too, unfortunately. There'll be some, we're seeing it right around here, people losing their jobs. You know, if we aren't in a recession already, I can't believe this won't push us into one. But finance isn't the real economy, and while finance, you know, what's going on in the financial world is going to have effects on the real economy, it probably won't be quite as dire as the people who I rode in with this morning on the train from Greenwich think it's going to be.
The whole derivatives thing, it's so arcane and odd, and people don't understand it. How did all this happen kind of under the hood or under the radar, or and have such an immense impact? Well,
you know, the politicians right now are saying, well, it's because of outsized greed. And frankly, there's a little bit of that involved. As I said, people weren't satisfied with ordinary returns of after the tech bubble crashed, and, you know, you would look at your account and you were looking at maybe returns of 4 or 5%, historically normal, but not the kind of thing that people got used to in the 1990s. And so they went into alternative investment vehicles, hedge funds, private equity funds, trying to get bigger than normal returns. That caused them to push for a lot of these alternative instruments, whether it's derivatives or other levered investments, in order to try and get higher returns. And for a while they did. And as they did, more and more people piled in. But now the people who stayed in are paying the price. It's just like the tech bubble. If you got out in time, you're okay. But if you're still in there, it's going to hurt.